Hey everyone, and welcome to another video. This is part 2 of my deep dive analysis of Tencent, where I'll be going over their investment portfolio and the risks with regard to the Chinese Communist Party. And at the end, I'll be doing a valuation model, and you'll be able to see what I think is a fair price for Tencent today. If you haven't seen part 1, make sure you do. In that video, I go over Tencent's operational business, and I think understanding that is important to get the full context. Also, make sure to subscribe to the channel if you like this type of content. Alright, let's begin. In the first part of this analysis, we established that Tencent's operating business is a money printing machine with an extremely wide moat. But what is really fascinating and what makes Tencent really unique is the way management is able to deploy its cash flow to truly make the company a compounding machine. Tencent holds an investment portfolio of approximately 700 companies. As of Q3 2021, the fair value of these investments was 1.2 trillion Chinese yen, which is the equivalent of 185 billion USD. Unfortunately, they did not officially disclose specific details about their investments, but by doing some research, I've been able to make a small compilation of their largest and most important ones to date. As you can see here, I've ordered them by industry. These are some of the largest and fastest growing gaming, music, and tech companies in the world. To begin, we can see a bunch of e-commerce companies, including the largest ones in China, including Meituan, JD.com, and Pinduoduo. And I'm going to linger on these three for a second because they are key to understanding Tencent's business strategy. You might already know that Tencent's arch rival is Alibaba. These two companies basically compete on every single front imaginable. Well, one of Alibaba's main business segments is e-commerce. That's why people often compare Alibaba to Amazon. To compete with Alibaba's e-commerce platform, Tencent didn't invest in warehouses, truck drivers, planes, etc. Unlike Alibaba or Amazon, Tencent would never spend money to hire a warehouse worker or a delivery driver. Instead, they straight up invest in Alibaba's biggest competitors like Pinduoduo, JD, etc. to do the dirty work of logistics and use WeChat to boost their distribution and visibility. JD competes with Alibaba on the high end of the market, differentiating themselves through their amazing customer service. Pinduoduo, which began as a fresh produce platform, competes on the lower end of the market. And Meituan competes on the whole spectrum thanks to their excellent distribution platform and speedy delivery. As these three companies grow in their influence, Alibaba is being squeezed on all ends of the market. Again, all of this is because of WeChat, which is Tencent's weapon of cash generation and mass marketing. Tencent can cherry-pick the best companies, invest in them thanks to the giant cash flows coming from their operating business, and guarantee their own success. Other than that, we can also see that they own some fast-growing UK e-commerce companies like Gorillas and Farfetch, and they've also invested in an Indian e-commerce company called Flipkart. I'll go over the gaming investments very quickly because I talked about this in part 1 of this analysis. But essentially, Tencent owns some of the biggest gaming studios in the world, as well as many smaller studios with really promising prospects. As I mentioned in the previous video, studios who want access to the Chinese market have no choice but to partner with Tencent, and Tencent is able to once again cherry-pick the best games to invest in. The third biggest industry Tencent loves to invest in is transportation. We can see electric vehicle makers NIO and Tesla, as well as unicorn companies like Uber, Lyft, and Ola, which could be the self-driving/taxi networks of the future. Apart from Tesla, Tencent invested in all of these fast-growing companies pre-IPO, aka probably at fair-ish valuations. In the case of Tesla, Tencent invested in 2017, so for approximately $50 per share, way before Tesla became a super hyped company. And as of today, they own 5% of the entire company. A lot of investors try to find the next Amazon, the next Netflix, etc. etc. The thing is with Tencent, they have a full team of capital allocators searching for the next unicorn, and they have plenty of free cash flow to spare on growth opportunities that may seem like venture-style investments. And for me, I like to focus my research on established, large-cap companies. So if Tencent is willing to do the hard work and find small private startups with decent valuations that have the potential to win large markets, I'm all for it. I would never invest in Tesla at the current market price, but I still think Tesla is a wonderful company doing amazing things in the world. And they have been extremely successful, growing at an exponential pace for the past few years, so if Tencent can benefit from that, great. Next up, we can see that Tencent has investments in some fast-growing tech companies like Snap, Spotify, and Reddit, which is still a private company by the way. We've got CLTD in Singapore, which is essentially the Southeast Asia version of Tencent. Then there's Discord, a few streaming platforms including Huya and Douyu, which are being rapidly adopted by gamers in China. And finally, we can see that Tencent is investing in neobanks as well, one in Brazil and one in China. Overall, Tencent's portfolio is very diverse by industry, although you could say that their investments are social tech oriented. Not only that, but they are also well diversified geographically. If you look at this chart, you can see that almost half of their entire portfolio comes from companies outside of China. Tencent uses the cash it generates in China from its operational business and domestic investments to diversify away from China. This is a really good thing if you consider how unpredictable the Chinese Communist Party can be. And what I also find fascinating is how management is willing to make bets across businesses at all stages, from small private gaming studios to mega caps like Tesla and CLTD. And considering that Tencent is invested in more than 700 businesses, most of which aren't even publicly traded companies, I would be willing to bet that investors undervalue that portfolio. Late in 2021, Mohnish Pabrai posted a video on his YouTube channel where he described Tencent as one of the highest quality businesses in the world. He made some really good points that I want to share with you. On capital allocation, he said that Amazon and Tencent are the only big tech companies that can allocate capital well. All of the others are drowning in cash. For example, Apple has 62 billion in cash on the balance sheet, Microsoft has 130 billion, and Google has 140 billion. On the other hand, Tencent has net debt. This comes from Pony Ma's unique business model. The first is his army of software engineers. That's Bazooka number 1. They focus on video games and other digital businesses, and this allows the company to produce an obscene amount of cash flow. Bazooka number 2 is Ma's army of digital Warren Buffetts. They go and invest in minority stakes or full acquisitions. Pony Ma makes sure that every single dollar in profits is used. Apple, Google, and all those companies with mountains of cash in their balance sheets, they don't mind making 1% returns on 70 billion of cash that's lying in the bank accounts. Whereas Pony Ma makes sure every single dollar is being used. In fact, if the operating business makes 15 billion in cash flow, he will use 15.5 billion to invest. This creates a compounding machine. Tencent is able to direct the second bazooka outside of China to minimize CCP risk and increase growth. Bazooka 1 earns 65% annualized return on capital, while Bazooka 2 makes 35% return on invested capital per year. So far, so good. Tencent is looking like an unstoppable force. But what about regulation from the Chinese Communist Party? Surely that poses a risk. One of the most famous principles of investing is buy low and sell high. Buying low implies investing in the company when the prices are depressed relative to fair value. The issue with that is, it's hard to figure out when a company's price is depressed for legitimate reasons and when it's depressed due to an overreaction from Mr. Market. But I think what we can all agree on is that when a company is surrounded by pessimism and no one wants to touch it, it's probably a good time to do some due diligence to figure out if the market is indeed overreacting or not. In the case of Tencent and many other Chinese tech companies, the pessimism has been extreme since mid-2021. It all started when Didi, which is the equivalent of Uber in China, was hit with a whole bunch of regulatory concerns only 48 hours after being floated on the New York Stock Exchange. In essence, the Chinese Communist Party is well aware that most of their private companies collect enormous amounts of data about Chinese citizens and is very wary of sensitive information being leaked, notably in the hands of the United States. On the other side, you've got the SEC in the United States that regulates stock markets, and they want open access to the books of companies which decide to list on their exchanges. You know, naturally, just to protect investors. This conflict of interest led to Didi being ordered to withdraw from all app stores and banned from accepting new users, which of course sent the stock price plummeting. This event sparked fears of Chinese companies being delisted from US stock exchanges, but to be honest, this isn't really a real risk to the company. More so a risk to the investors who would probably end up seeing the stock price go down dramatically if this fear were to materialize. Personally, I've bought my shares of Tencent on the Hong Kong Stock Exchange, so if anything, I would buy more shares if the stock price came down. A more relevant risk to an investment in Tencent comes from the Chinese government directly interfering with the business models of their big tech companies. In 2018, Tencent's stock price tumbled 40% in a matter of months as the CCP was cracking down on gaming. After expressing his concerns of worsening eyesight in children, Xi Jinping brought about regulations over the number of online games released. For a number of months, Tencent was blocked from releasing any new titles, and that had a big impact on their net income and free cash flow for that year. Eventually, the government gave the green light for new releases, but in 2021, they struck again by enforcing limits on how much time children are allowed to spend on video games every week. And perhaps no other move scared investors as much as the failed Ant Group IPO in 2020. Ant Group offers online savings and investment services. This company grew out of Alibaba's Alipay online payment services, and Jack Ma, the CEO of Alibaba, was planning on taking the company public in Hong Kong and Shanghai. Days before the IPO, Xi Jinping ordered Ma to pull the plug though. And the reason? Xi Jinping wanted Ant Group to act more like a bank instead of a fintech company. That meant vetting borrowers, managing lending risks, minimal capital requirements, and more importantly, a bigger emphasis on data protection. So the question becomes, why is the Chinese Communist Party seemingly sabotaging the development of domestic businesses? There are three major themes that come back again and again in the media. We already touched on the first, and that is the control over national data. Big tech firms like Tencent and Alibaba have billions of Chinese citizens using their services for everything, from payments to e-commerce and businesses, etc. Chinese leaders see all of this data as a tool for gaining insight into the public and the economy, but also as a potential security risk if the data were to fall in the wrong hands. That would explain Xi's government tightening control over data gathered by private companies about the public. The second major theme revolves around common prosperity, one of China's core principles. I really like this quote from The Guardian. Under Mao Zedong, everyone in China was poor. Under Deng Xiaoping, people remember the catchphrase, "to get rich is glorious," but Deng also said that ultimately, China will have to achieve common prosperity. And now that China has reached middle income status, Xi thinks it's time to deliver the latter part of Deng's mantra to ultimately achieve common prosperity. Xi Jinping really believes that unrestrained capitalism leads to wealth inequality, and he has on many occasions said that achieving common prosperity was a major economic and political goal for him and his party. 40 years ago, President Deng Xiaoping enabled economic liberalization, which propelled China to become the economic powerhouse that it is today. However, the booms in manufacturing and technology that occurred over the years have allowed a few business people to accumulate great fortunes. Some people see the recent crackdown on tech as attempts at redistributing wealth back to the people. As a matter of fact, less than 24 hours after the government vowed to regulate excessively high incomes and encourage high-income groups to return more to society, Tencent CEO Pony Ma pledged $2 billion to charity, and Alibaba promised to spend $15 billion on job creation and rural development. On top of that, Tencent promised to invest $70 billion in digital infrastructure, while Alibaba and other tech companies committed to similar investments. So it seems that Beijing is using the crackdown in part to narrow China's politically sensitive wealth gap by pushing tech giants to share their wealth with employees and consumers. And finally, the third major theme revolves around political conflicts of interest between Chinese big tech and the CCP. The government is essentially worried about its companies getting too big and independent of the party. China's tech CEOs are some of the wealthiest Chinese citizens, and with money comes power and influence, both of which might pose a threat to the government. Cutting off the flow of dollars into the economy, or at least trimming it, might be a price Beijing is willing to pay for greater control. Taking all that into account, I think it's also a good idea to hear what people who invest a considerable amount of money in China have to say about this situation. One of the most respected investors who specializes in China is Dalio, and what makes him an expert, so to speak, is that he has spent a lot of time in the country since the 80s, interacting with top government officials as well as more humble locals. So it's fair to say that he understands their customs and culture more than the average Westerner does. I'll try to summarize his main ideas in a few minutes. The first point he really emphasizes is that China is not communist. As a matter of fact, they are extremely capitalistic, as can be seen from the economic growth of the country over the past several decades. They just subscribe to a different form of capitalism. As Deng Xiaoping once said, it doesn't matter if it's a white cat or a black cat, so long as it catches mice. Yes, capitalism in China is different, but it works. At the end of the day, the nation is still getting wealthier and wealthier year after year. On common prosperity, Dalio thinks people are wrong to assume that China will end up reverting back to a Maoist society. According to him, China is very capitalist, even more so than Europe. For example, Xi Jinping made it a point to open a new stock exchange in Beijing just last year. However, the system works in a different way. It has a different structure of power where the capitalist isn't in control, the state is. The system in China works with a top-down approach, almost like a strict parent. They want their kid to do well, but they still need them to follow the rules. That would explain why the government loves to meddle in affairs like the video games business, etc. If they think the capitalist approach is detrimental to society, or children to be more precise, they will have no problem with establishing stricter rules. To Dalio, China and the United States are the most capitalist countries in the world. Both have different systems, their own risks, and he thinks it's a good idea to diversify your portfolio so as to have exposure to both. He also thinks that a long-term approach is absolutely necessary when investing in China. The reason is simple. China's goal of common prosperity is a long-term goal. The CCP might crack down on certain sectors here and there every few years, but their goal is still to increase the wealth of the country over the long term. And to be fair, if you look at China's GDP growth trend over the past few decades, you can clearly see that their approach has largely been successful. At the end of the day, not many people can deny the fact that China will become the largest economy in the world at some point in the coming decades. But that's the trick. When you invest in China, you need to think in terms of decades, not months or years. Let's look at this valuation model I created for Tencent to see what kind of returns we could expect from the business if we invested today. Over here we can see the historical financial data over the past 5 years since 2016. The revenues have been increasing very fast from 2016 to today, from 152 billion Chinese yen to 550 billion Chinese yen. And net income and free cash flow have also been following the same trend. I like to see shares outstanding going down over time in a company because that gives me more share of the business. In this case, they're actually going up, but it's by a very little amount every year, so I'm not too worried about that. Since 2016, we can see that the average revenue CAGR was 29% per year. The average operating margin was 29% as well, and the free cash flow margin was 25%. I like to invest in companies that have consistently high returns on invested capital, and in this case, Tencent has a return on invested capital of 19%, which is really good. Anything above 10% is decent. And we can see that the debt to equity is 0.3, which is really low. It's good to have a number below 1 usually because this means that the company has very low chances of going bankrupt. So based on these assumptions, I've made 3 different models, each with a different revenue CAGR assumption for the next 7 years. My base case has a revenue CAGR assumption of 15%. The bear case has a revenue CAGR of 10%. And the bull case has a CAGR of 20%. So clearly you can see this is very conservative compared to the 29% that Tencent has been posting year after year since 2016. But the point of these models is that you want to make conservative assumptions just in case, just because we don't know what the future is made of. And in this way, if Tencent actually overachieves and keeps growing at 30% per year, then we will get a nice upside. But anyways, my first assumption with a CAGR of 15%, I've used a terminal earnings multiple of 20 and a terminal free cash flow multiple of 20 as well. I've used a 15% discount rate. And most importantly, I've added the investment portfolio value today that's at 1.2 trillion Chinese yen. And we get to an average present value of 4.2 trillion Chinese yen, which is the equivalent of a share price of 543 on the Hong Kong Stock Exchange and 68 in the US. For my bear case, I've used a CAGR of 10%, terminal earnings multiple of 18, and a terminal free cash flow multiple of 18. I've used a very conservative discount rate of 15%, which pretty much guarantees me a really good return. And we get a present value of 3.1 trillion Chinese yen. If we convert that to the share price, that's 411 Hong Kong dollars or 52 US dollars. So in this case, if the revenue only grew at 10% over the next 7 years, then the share price is overvalued today, because I believe the share price right now is at 470 Hong Kong dollars. And finally, with my bull case, I've assumed a revenue CAGR of 20% over the past 7 years. So even this one is still 10% lower than the actual revenue growth rate that Tencent has showed over the past 5 years. I've used a terminal multiple of 22 for both free cash flow and net earnings. Again, discount rate of 15%, and we get an average present value of 5.6 trillion Chinese yen. With these assumptions, you would be able to make 15% per year by buying Tencent at this price, which is way higher than the current share price. Full disclosure, I've bought a lot of Tencent in the past few months. My average share price is 476 HKD, which is equal to 61 USD. That price is right in between my base case and my bear case in terms of assumptions, and I'm very comfortable with that. Tencent is usually able to grow around 30% every year. If the business is only able to grow around 12% per year for the next 7 years, I should be able to make a very nice return. That's the end of this video. Remember to like and subscribe if you haven't already, and I'll see you in the next one.